Hello everyone, welcome to Social Security for EPFO. In the first class today, we shall discuss the concept of social security in India as well as the various social security schemes in India for the purpose of enhancing welfare of the labor class. Okay, let us begin. So, firstly, what is social security? Social security is the protection that a society provides to individuals as well as households to ensure access to healthcare and to guarantee income security, particularly in the few discussed cases above. Okay, so there are two things to note here. Firstly, is the beneficiary. Who is the beneficiary of social security? First, it is the individual because the individual ultimately carries the rights, and second is the household, which is a collective unit, the family, because ultimately the labor which is earning for multiple people. A laborer is earning not just for himself but for his family, for his children. A female laborer is also earning for her children, for her husband, for the overall nutrition of the entire household. So, therefore, there are these are decisions which are not just an individual's decisions, these are decisions that affect the entire family as a whole. So, therefore, the concept of social security takes care of both the individual who has to be given rights. Sometimes the individual has to be protected from the family itself, because there could be a case where the family sends their kid for child labor. So it is not just the family but the individual child also who has to be protected, right? But simultaneously, we also have to take care of the household. And there are two primary objectives that have to be ensured or guaranteed to all individuals and households under social security. First is income security, and second is healthcare. Why only these two? Because these comprise of most important the most important facets of life. Through income, you can purchase any goods and services. So, income brings you opportunity, it brings you choice. You can choose where you want to send your child to school. You can choose what car you want to buy. You can choose what kind of television you want to purchase as long as you have money. So that is first, and the second is healthcare. And health is equal to wealth. This is one of the most important things, that unless you have health, you will not be able to earn. And if you're not able to earn, then you will lose income also. So health is the most important, which is why access to healthcare comes before guarantee of income security, because this is where the largest and the most important part of expenditure happens. So these two, once they are granted in healthcare, by healthcare I mean nutrition, primary healthcare, secondary and tertiary healthcare. Even for example, if you're hospitalized, if you have to go through surgery, that is also included. Diagnostics, aftercare, all of these are important. Okay, so it is a broad term in which I mean healthcare as well as income. So healthcare gives someone life security, and income gives someone choice security. Okay, there are certain sections in society which are more prone to the loss of these options, both healthcare and income, and which is why social security is provided more potently to these sections of society. Okay, first is old age, elderly people. Why? Because they are past their prime. Statutorily, many have to retire. There are, if they are in government services, then they have to retire. They are replaced by new generation, which is faster, more adaptive, stronger, healthier. So they need income security as well as health security because they are more prone to disease, right? The more you age, the more prone to disease you become, right? So first is elderly, second is unemployed. Unemployed, why? Because they have no income, so they are likely to fall into the poverty trap. Poverty trap is that once you have no income, your health goes down, then you are unable to work, and this means you will have no income, and your health will keep deteriorating also, and therefore you will not be able to improve from the situation. In cases of sickness, because the health expenses are too high. In cases of invalidity, invalidity means disablement of permanent form, because now you can't work, especially for the labor class. If you are invalid, then you are unable to get employment anywhere. Why will someone hire you for the full wage? For work injury, for the same reason. For maternity, because you are required to care for a child, therefore unable to earn, and also need more medical access. The last is loss of a breadwinner, that if you lose the earning member of the family, then also you will need income security. Okay, so this is why we need income security for these different groups. There are 5 basic components of security. These were discussed in the Beveridge report of 1942. So the Beveridge report was from the UK Labour Party for suggesting reforms as to post World War II agenda on social security. This was one of the first this was one of the first measures of social security that were taken or announced. Prior to this, the concept of social security did not exist, but the very high inflation in society as well as other issues, they led to the formation of this report. So this was by an economist called Mr. Dr. William Beveridge. Okay. Dr. William Beveridge was an economist who identified 5 major problems in society that had to be resolved. These 5 evils, as the report called it, was want. Want means poverty, that you are lacking. By Dr. William Beveridge. Want, which is poverty, disease or sickness, ignorance, which is the lack of education, lack of knowledge, scholar, which means poor living conditions, and idleness, which is unemployment. Okay, so these were the 5 uh, evils that the Beveridge report identified: want or poverty, disease and sickness, ignorance or lack of education, squalor or poor living conditions, and idleness or unemployment. So, for this, the Labour Party came up with a 5-point suggestion. First, to provide basic amenities such as food and shelter to eradicate poverty. First was basic amenities to eradicate poverty. Second was healthcare. The National Health Scheme was formed, the NHS in the UK, to provide immunity, social immunity against diseases. Third was a comprehensive state-backed education scheme to tackle the problem of ignorance or lack of education. Fourth was a focus on hygiene and sanitation to improve the urban living conditions. Living conditions specifically. And the last was employment. This was a post-war reconstruction plan called the Marshall Plan. Okay, to generate employment by improving the social security available in the society. So these were the 5 components of the Beveridge report, which was basically the first statement of social security in the entire world. Okay. Please also note that there was also a Social Security Act 1935 in the USA, which was meant to give pension to labor class. However, the Beveridge report was the first comprehensive statement that discussed social security holistically. Okay. Now we come to the World Social Protection Report of the International Labour Organization. We had discussed the scope of the ILO. The ILO also took up the idea of social security after the Philadelphia Declaration of 1944. We have discussed this in an earlier class. Okay. The World Social Protection Report provides a comprehensive analysis of the social protection systems and policies worldwide. The World Social Protection Report highlights the progress made in expanding social protection coverage and identifies the gaps that remain. For example, in the 2020 to 2022 report, the ILO noted that 47% or less than 50% population had access to at least one social security scheme. Okay, so a little less than 50% of the world had access, which was also divided by region. So for example, in Europe and Central Asia, 84% population has social security scheme access, whereas in Africa it is 17%. So this is something which identifies as gaps in social security that the ILO has identified. Okay. The report emphasizes the importance of social protection in promoting inclusive economic growth, reducing poverty and inequality, and achieving sustainable development goals, the SDGs. There are 17 SDGs, and the report discusses how social security can reach SDGs. It also discusses the impact of the COVID-19 pandemic on social protection systems and the need for countries to strengthen and expand systems to better respond to future crises. The report provides recommendations for policymakers to build more effective, efficient, and sustainable social protection systems. There are no specific recommendations which are important from EPFO perspective. For those studying UPSC, you might go through them. It has statistics on uh, how many women. It says about 45% women receive maternity benefit, so about 55% are left out, etc. A lot of these statistics are given in this report. However, from the perspective of EPFO, this is not very important, so I am not going to cover the statistics given in the report beyond what I have already covered. Okay. Social security has been a very important part of the human rights discourse and the rights discourse in general. The Universal Declaration of Human Rights, or the UDHR, which was adopted by the United Nations General Assembly in 1948, recognizes the right to social security as a fundamental human right. Okay, so please see that this is the entire era when social security and labor rights were getting prominence, because after the Second World War in 1942 we already have the Beveridge Report. In 1944 we have the ILO's Philadelphia Declaration. In 1948 we have the Universal Declaration of Human Rights. All of these call for social security as well as labor welfare. So this is a very important time frame in which labor rights were being taken very seriously by the entire world. Okay. So let us see what the UDHR says. Article 22 of the UDHR states everyone as a member of society has the right to social security and is entitled to realization through national effort and international cooperation and in accordance with organization and resources of each state of the economic, social, cultural rights indispensable for his dignity and the free development of his personality. Okay, so basically, they have the right to social security and all such rights which are important for the free development of personality and dignity. These are what the Universal Declaration of Human Rights calls as a part of a fundamental human right. And please understand, this is one difference that we'll see between the UDHR and the ICESR, the International Covenant on Economic and Social Rights. We'll just discuss this. But UDHR gives rights. The ICESR only declares rights without much obligation upon the state. There is a slight difference that you will see in the language, and the political context for it will justify it. So, is entitled to realization through national effort and international cooperation and in accordance with the organization and resources of each state. So, this basically puts the onus on every state ultimately that if you have the resources, please guarantee everyone and provide to everyone the right to social security. Otherwise, there is no such requirement, because if you don't have the resources, then you will not do it. Simple. So, the UDHR only places the responsibility on the state according to their resources. Then, the next we have the International Covenant on Economic, Social and Cultural Rights, the ICESCR. Okay. The International Covenant on Economic, Social and Cultural Rights is a human rights treaty adopted by the United Nations General Assembly in 1966. The ICESCR recognizes the right to social security as a fundamental human right and obligates state parties to take steps to realize this right. Okay. Article 9 of the ICESCR says the state parties to the present convention recognize the right of everyone to social security, including social insurance. The state parties to the present convention recognize that for those who are unable to secure the enjoyment of the rights set forth in the present covenant by their own efforts, state parties have the responsibility to undertake to ensure the necessary social security and shall take necessary steps, including through international assistance and cooperation, especially economic and technical, to the maximum of its available resources to achieve progressively the full realization of this right without prejudice to obligations contained in the present covenant to respect, protect, and fulfill human rights and fundamental freedoms. So, this is what I was talking about, that the UDHR gives rights to people. The ICSCR places obligations on states. It's a slight difference if you might have noticed. I probably notice this more because I am a lawyer, but there is a slight difference in the language, that the states now have an obligation and that is highlighted everywhere. Whereas in the UDHR, it was the right of the individual which was highlighted, and the states only had to ensure that they fulfilled the right. Now we come to the components of social security. Okay. What does social security consist of in material terms? Basically, what should the government actually give to the people for it to be counted as a social security measure? So, there are five components of social security. First is a cash transfer. This includes programs that provide regular cash payments to eligible individuals or households, such as social assistance, child benefits, unemployment benefits, pensions, etc. So you have different schemes such as Matru Vandana Yojana or Kisan Samman Nidhi or the self employment for manual scavengers, which provide either one time or routine cash transfers. Okay, so that they can stand on their own feet and they can improve generally in life. The second is healthcare. This includes programs that provide access to medical care, such as public health insurance, medical assistance, free or subsidized health services. So, for example, in government hospitals, you will get subsidized treatment. Further, there is the Jan Aushadhi scheme, the Jan Aushadhi Pariyojana, which gives generic medicines. Then there is the Ayushman Bharat, the Jan Arogya Yojana, which gives health insurance. So, all of these are covered in the concept of healthcare, that you give medicines, that you give subsidized health treatment, and uh, also health insurance or health cover. Then we have social services. Social services include programs that provide support for basic needs and social services such as housing assistance, food assistance, education, child care, etc. So, PM Awas Yojana for housing, Swamitva scheme. Then there is the National Food Security Act or the PDS system for food security. Then we have the Samagra Shiksha Abhiyan, as well as PM E-Vidya for education. Then we have the Integrated Child Development Scheme, as well as the Matru Vandana Yojana, which gives child care. So all of these are social service schemes. Okay, they provide social services which are basic necessities. Even schemes such as PM Ujala, which gives LED lights to everyone, Ujwala, which provides gas connection, These are also social service schemes. Okay. Then we have labor market programs. Labor market programs include programs that support employment and promote labor market participation, such as job training, employment services, and subsidies for employers to hire workers. So you have the Atmanirbhar Bharat Rozgar Yojana, you have the PM Kaushal Vikas Yojana, the Grameen Kaushal Vikas, you have the Manrega for employment generation, you have National Rural Livelihoods Mission, you have the Skill India program. So all of these exist to provide and to increase labor market participation. And the last is social insurance. They provide protection against specific risks such as disability, old age, work related accidents through insurance programs which require contributions from the individuals or employers. Okay, so you have the Suraksha Bima Yojana, you have the Jeevan Jyoti Bima Yojana. All of these are social insurance measures. Okay, so these are the 5 components of social security. Now let us discuss the code on social security. The government in 2020 had replaced many existing laws with 4 labor codes. So about 29 labor laws were replaced with 4 labor codes. So we had discussed 3 in the last class. Now we are discussing the code on social security. So the social security code takes over or replaces 9 statutes. These are the following statutes that it replaces. First is the Employees Compensation Act 1923. Second is the Employees State Insurance Act of 1948. This is a central law. Okay. It says that State Insurance Act. However, this is not a state law. This is a central law. Third is the Employees Provident Fund and Miscellaneous Provisions Act 1952. Under this act, the EPFO, for which the exam that we are preparing for has been established. Then we have the Employment Exchanges Compulsory Notification of Vacancies Act 1959. Then we have the Maternity Benefits Act of 1961. Then we have the Payment of Gratuity Act 1972. We have already discussed this in the labor law class on wages. Okay. Then we have the Cine Workers and Welfare Fund Act 1981. Building and Other Construction Workers Welfare Cess Act 1996. And the Unorganized Workers Social Security Act 2008. All of these 9 laws will be replaced by the Code on Social Security. However, this has not been notified yet. Okay. Merely if the Parliament passes a law does not make it binding. The government has to notify the law. So unless these laws are notified, they will not become operational. And so as of now, the Employee State Insurance Act, the EPF Act, maternity benefits, payment of gratuity, all of these acts continue to remain relevant even today. So over the course of these classes, we shall be discussing the existing laws also. I am only giving you a brief overview of the Social Security Code so that later on you are aware of what differences have been set up. These are some of the salient features of the Social Security Code. There is protection to organized and unorganized sector. Next, the gig workers and platform workers are also protected. This provides for a definition because of the changed working surroundings. The 21st century has a new kind of labor. The gig worker. Okay, these are Uber drivers, delivery persons such as Zomato, Swiggy, etc. All of these will be part of the gig worker economy. And the platform workers, they did not exist earlier because web based applications did not exist, so there was a clear uh, employee employer relation. But with the course of time, there is no human interface between the service provider and the service consumer. As an intermediary, there is only app, which may not be directly relevant to the business transaction. So, these gig workers and platform workers don't become employees of Uber or Zomato, and that leaves them outside of the entire social security net otherwise. So, therefore, you have these problems, which is why, to give them social security, the Social Security Code defines gig worker as a person who performs work or participates in a work arrangement and earns from such activities outside of traditional employer employee relationship. This is the most comprehensive definition under the code because it consists of all such activities outside of traditional employer employee relationship. The other definition is of a platform worker, who are mainly persons who provide services through web based platforms which act as an intermediary. This is a subset. Let us say this is the gig worker, a platform worker is only a subset of the gig worker economy. The Social Security Code also provides for setting up of call centers for unorganized workers helplines. Okay, often they are unable to avail of legal remedies because the employers are large, workers are small individually in resources. So therefore, these helplines will provide for legal remedies as well as inspectors for violation investigation. The next major feature is that there is overarching presence of digital compliance. Okay, all social security contributions can be made digitally, and all of these can also be verified online whether the person has received the services. These measures will be set up by the government. Okay, the code only provides for digital compliance. Therefore, it is upon the government to come up with such a system. Okay, these are the major salient features of the Social Security Code. We will also discuss some major provisions. Most of the things have remained more or less the same. The limits have changed, which I am not specifically discussing, because at present the code has not been notified yet. Okay, and a lot of things has been left for rules. We had discussed that much of the other laws also have the idea of prescribed in rules by the central government. So this is also something that is carried forward by the government into the Social Security Code also. Some other major provisions have provision for inspector cum facilitator to ensure social security policies are being followed. Earlier there used to be only inspectors, the labor commissioner, etc., who would inspect and fine for violation. Now there is a concept of facilitator, that you are inspector come facilitator, so you will help to identify flaws and give recommendations first. Only when the recommendations are not followed will you recommend a will you uh, levy a fine upon the failing employer. Otherwise, you will go, you will first inspect and see whether there are violations, then you will facilitate the employer in overcoming the violations. This will ensure that there is no undue harassment of the employers, because the inspector, it is also the inspector's job to ensure compliance, not just to collect fines. Some major points of change have been that there is no change in the provisions of maternity relief, that the concepts, the limits of 26 weeks which were prescribed in the Maternity Benefits Act, 26 weeks, that is what will continue in the Social Security Code. The cess for building and construction workers has been continued. Other cesses might be notified, but this cess for building and construction workers has been continued. Okay, these are some of the major provisions of the Code on Social Security. There are some new authorities which have been created under the Social Security Code. First is the Central Board for Provident Fund. The Central Board for Provident Fund will replace the Central Board of Trustees for EPFO. The second is the National Security Board for Unorganized Workers. National Social Security Board, sorry. The National Social Security Board for Unorganized Workers. Okay. The third is State Unorganized Workers Social Security Board at the state level. This was the national level, this is the state level. And the last is Building and Other Construction Workers Welfare Board for Pan India construction activities. Okay. We will discuss the EPFO provision separately in the class for EPFO. Now let us come to the schemes for social security in India. Okay, India is a welfare state. The constitution provides for various welfare measures to improve the equality as well as dignity and liberty of the individual. There is a very specific provision in Article 41 which provides for the social security provisions, the right to work, education, as well as public assistance in cases of unemployment, old age, sickness, and disablement, and in other cases of undeserved want, which is poverty. Okay, so this is what the Article 41 provides for. And there are multiple acts and schemes which give effect to the provisions for social security in India. So let us discuss those acts and provisions briefly. First, we have the con- acts and schemes for food security and basic amenities. Okay, so the most important food security schemes are public distribution system and the National Food Security Act of 2013. The PDS provides for ration shops, also called the fair price shops, for grain distribution. The NFSA provides for the NFSA covers about 75% of the rural population and 50% of the urban population of India, which is combined into 60% of the total population gets food security cover. Okay, please note that under the PM Garib Kalyan Anna Yojana, 80 crore people will be given free grains every month. So this merges the NFSA and the PDS for the time being. Okay. Then we have the National Social Assistance Program. This provides for various pension schemes to different categories of people, such as the old age pension, the widow pension, disability pension, family benefit scheme, and the Annapurna scheme for food security. All of these come under the NSAP. Okay. Then we come to the ICDS. The ICDS is the Integrated Child Development Scheme. This provides for early child nutrition through Anganwadis. Okay. Then there is the Ayushman Bharat PM Jan Arogya Yojana. We will discuss this in the next class properly. There are other schemes such as Pradhan Mantri Ujjwala Yojana. Ujjwala gives gas connection and to BPL houses. Okay, gas connection to BPL houses, and PM Awas Yojana, which aims for universal housing access. So these are some schemes for food security and basic amenities. Then we come to some schemes for income security. Okay, we will discuss all of these in the coming classes, these schemes. So I am not going to elaborate upon them very much. The PM Shram Yogi Mandhan Yojana, the PM Kisan Mandhan Yojana, the National Pension Scheme for shopkeepers, traders, self-employed persons, Atal Pension Yojana, PM Vaya Vandana Yojana, EPF and Miscellaneous Provisions Act, Payment of Gratuity Act we have already done, PM Kisan Samman Nidhi, PM Jan Dhan Yojana, National Pension Scheme, and the Sukanya Samriddhi Yojana. Okay, we will discuss most of these schemes in good detail. Only those which are related to the labor sector we will discuss in detail. The others, it is just important to know that these schemes also exist. Okay. Then we have the employment assistance programs, such as the Mahatma Gandhi National Rural Employment Guarantee Act, or the MG Narega, which guarantees 100 days employment to all willing persons. This was the first time the right to work was properly given a statutory format. Then we have the Unorganized Workers Social Security Act, which provided for a social security fund for unorganized sector. We will discuss the e-Shram portal in the coming class. Then we have the Pradhan Mantri Rozgar Protsahan Yojana for boosting the economic scenario of the employers so that they can generate employment. Then we have the Atmanirbhar Bharat Rozgar Yojana. This also provides income benefits to employers so that they can provide better employment. Then we have the National Rural Livelihoods Mission, which engages self-help groups at the rural level. We have the self-employment scheme for manual scavengers, for rehabilitation of manual scavengers, which gives them 5 lakh rupees to restart their lives. And then we have PM Swanidhi, which helps street vendors. So these are some of the employment assistance schemes which help people to stand on their own 2 feet or to provide employment or to get employed in the first place. Another example could be the PM Kaushal Vikas Yojana, which provides for skill development of the workforce. There are other social assistance schemes also. We will not be discussing them properly because there is no specific point where they fall in, but there are one-stop center schemes for women welfare, Swadhar Graha scheme for juveniles, PM Matru Vandana Yojana for early child care. And we have the Pencil Portal, the Accessible India campaign, Rashtriya Vayoshri Yojana for disabled people, for old people, Maternity Benefit Act of 1962 for pregnant women, the PM Jeevan Jyoti Jeevan Jyoti Bima Yojana for life insurance, and the PM Suraksha Bima Yojana for accident insurance. We will discuss these two schemes in the next class in the part on insurance. Okay. So these were some of the components of some schemes for social security. Let us discuss some previous year questions. First, which one of the following is the correct set of contingencies identified by William Beveridge in his comprehensive social security scheme? A. Want, disease, ignorance, scholar, and idleness. B. Want, sickness, disability, scholar, and idleness. C. Want, disease, old age, scholar, and unemployment. Or D. Disease, invalidity, old age, unemployment, and ignorance. We had discussed the Beveridge report provides for these five, that want, disease, ignorance, scholar, and idleness. These were the contingencies identified by Dr. Beveridge. Okay, so the correct option is A. Next question. Everyone, as a member of the society, has the right to social security and is entitled to the realization through national efforts and international cooperation and in accordance with the organization and resources of each state of economic, social, and cultural rights indispensable for his dignity and free development of his personality. This statement has been uh, is emphasizing the importance of social security has been expressed in which of the following? A. Universal Declaration of Human Rights. B. Philadelphia Declaration of the ILO. C. Report of the First National Commission on Labor. Or D. The Directive Principles of State Policy of the Indian Constitution. We have studied all four of these documents. The correct answer is A. Universal Declaration of Human Rights. Okay. Thank you. Hello everyone. Welcome to the second class for Social Security for EPFO. In this class, we shall discuss the concept of insurance and the state machinery and various schemes for insurance of the working class. Okay. Let us begin. Firstly, what is insurance? Insurance is a contract represented by a policy in which a policyholder receives financial protection or reimbursement against losses from an insurance company. Okay. Therefore, there is always an insurance policy by an insurance company which shall provide finances or reimbursement in case of loss, injury, damage, etc. The insurance company pools the risk of various clients to make payments more affordable for the insured. Most people have some insurance for their car, house, healthcare, life, etc. This pooling of resources is the fundamental principle of insurance, that let us say you have 5 people, all of them contribute 10 rupees each to a common pool. Now they have 50 rupees. Two of them face damage of rupees 20 each, because it's not necessary that all 5 of them will face a damage. So then the insurance company will pay 40 rupees. The 10 rupees that they received is the profit. So by pooling resources, the people who got damaged saved rupees, that they only paid rupees 10, whereas otherwise they would have to pay rupees 20, and the other people paid rupees 10 with the minimization of risk, that now whatever the cost will be shall be borne by the insurance company. If, for example, the loss would have been rupees 30 and 30, even then the insurance company, if they had in the contract that they can pay up to rupees 30, they would have had to pay rupees 30. They would have had to bear a loss, because it's a part of a contract. Now you can't go back from what you have committed in a contract. The insurance policies hedge against financial losses resulting from accidents, injury, or property damage. Insurance also helps cover costs associated with liability, such as legal responsibility for damage or injury caused to a third party. Let's say you had employee insurance, and then there was a lawsuit against you. If the insurance company has paid the claim, then they will fight the case. If they win, they will take the benefits also. Okay. So this is how the insurance business largely works. These are some basic terms about insurance. First term is premium. A premium is a policy's premium is its price, typically a monthly cost. It is the price for which you are being provided insurance. Okay. So let's say for 2 years you will pay rupees 100 each month for accident cover, and in case there is an accident, you will get rupees 50,000. That is one possible way of having an accident cover insurance. So the 100 rupees that you pay every month is the price of the insurance policy. That is called a premium. Okay. Then we have policy cover. A policy cover might cover specific kind of risks, incidents such as fire in the warehouse might be covered, but not theft or damage from riots in a building damage insurance, such as warehouse insurance you might have purchased. So the policy will disclose all incidents of what is covered and what is not covered. Okay. Then there is policy limit. The policy limit is the maximum amount an insurer will pay for covered loss under a policy. Maximums may be set per period, that every year, annually, what will be covered, or policy term, that over the course of the entire 20 years this will be paid, etc., etc. Then you can have per loss or injury, or over the life of the policy, also known as the lifetime maximum. Typically, higher limits carry higher premiums. That if you buy cover for rupees 1 crore accident insurance, then you might have to pay 10,000 every month. Whereas if you buy cover for rupees 1 lakh, then you might have to pay 100 rupees per month. All of this depends Okay. Then we come to the concept of deductible. Deductible is a specific amount you have to pay out of your pocket before the insurance pays a claim. The concept of deductible is introduced because deductible serve as deterrent to large volume of small and insignificant claim. Let's say you paid rupees 1000 at a hospital and you claim it from the health insurance. Then the insurer will have to verify whether the claim was correct or not. And for if they have to pay, if they have to check every rupees 1000, rupees 200 transaction that you paid, then they are going to go in a loss only for the verification capacity itself. So therefore, sometimes they include a clause for deductibles that only when the bill is above 5000 and you have paid 3000 rupees shall we cover the remaining 2000 rupees. Such a clause might exist so that they know that you have paid a good amount of part and the bill was big enough that they can verify. Another example, for example, a claim of 10,000 deductibles means you pay the first 10,000 towards any claim. Suppose your car's damage totals rupees 50,000, you pay the first 10,000 and the insurer will pay the amount up till rupees 40,000. Okay. So these are some basic terms for insurance. Then we have the core principles of insurance. The first and the foremost principle is the principle of utmost good faith. It is called ubari me fida. For example, you might have heard bona fide, bona fide or bona fide as you pronounce it. So, bona fide means good faith, that you don't want to deceive someone. But the insurance contracts operate on the principle of uberima fide, which means utmost good faith, that you cannot hide anything that is relevant. According to this principle, you have to disclose all the information related to the risk to the insurance company truthfully. You must not hide any facts that can have an effect on the policy from the insurer. If some fact is disclosed later on, your policy will be cancelled. On the other hand, insurer must also disclose all features of the insurance policy. So, but because you are the person whose risk is covered, then you are responsible for disclosing the details. If you forget important details, then that is misrepresentation, and if you hide details, that is fraud. Both of this case will lead to cancellation of the contract itself. Whatever premium you have paid will be forfeited. You will not get back your premium that you have paid, and you will also lose the policy. Okay. Then we come to the concept of insurable interest. Insurable interest is a principle that says you must have an interest in the subject that is insured. That is, you will suffer financially if the insured subject is damaged. You cannot buy a life insurance policy for a person you have no insurable interest in. This is also valid when the person will not cause a financial suffering. So, for example, you have a paralyzed, disabled child. This was a real case, and the mother of the child tried to take a policy, life insurance policy, in the child's name, declaring herself as the beneficiary, the court held that there is no insurable interest, that there is no financial suffering that will be caused to the parents, even though there is going to be mental suffering, but that cannot be forced upon the insurance company. So therefore, there is no insurable interest with the parents in this case. Only when you are dependent, that is also existing when the child is not earning. Only when the parent is dependent on the child, only then can you claim an insurable interest. Similarly, let us also try to imagine that A has promised to sell B some goods and C has guaranteed A's delivery to B. Now C has an insurable interest that if the goods of A are burnt down, then C will have to pay the guarantee. So he has the insurable interest and he can take insurance. So you will have to prove a financial suffering or possibility of financial loss for you to have an insurable interest. Next is the principle of proximate cause. Proximate cause is that while calculating the claim for a loss, the proximate cause or the cause which is closest and the main reason for loss should be considered. So for example, in a fire insurance, if fire was caused due to electricity failure, that will be considered. Just because there was low ventilation that the fire grew, or possibly that there was also some oil in one of the containers in the godown that the fire got worse, that does not mean that the insurer can deny the insurance claim. As long as the main cause was the electricity fire and the contract provides for electricity fire to be covered, the insurer cannot reject. Okay. This principle of proximate cause is not used in life insurance. Life insurance policies are paid off upon the death of the person itself without much investigation into the types of causes. Life insurance contracts don't have these clauses that you can only be covered when you die of certain ways. Next is the principle of subrogation. Subrogation basically means to replace the rights. Okay. This principle comes into play when a loss has occurred due to some other party and not the insured. In such a case, insurance company has a legal right to reach the party for recovery. Let us say there is a car damage case that someone got into accident with my car. I received car insurance payment by the insurance company. So I am happy. But someone got into an accident with my car. The insurance company will now get a right to pursue this legal case. Earlier I had the right to pursue the legal case against the person who got into the accident. But once the insurance company pays me the insurance amount, after that they will get this right instead of me. They will replace me as the right holder. This is the principle of subrogation. Next is the principle of indemnity. This principle means that insurance will cover only those losses that have actually happened. The insurer will thoroughly inspect and calculate the loss. The main motive of this principle is to put you in the same position financially as you were before the loss. The principle does not apply to life insurance also. For example, My godown was burnt. I had taken a policy of rupees 2 crore for the godown, but the actual loss I suffered was rupees 80 lakhs only. I will be paid rupees 80 lakhs only. I will not be paid rupees 2 crores just because I took a policy for that. I will only be paid back the loss that I have had. The insurance is not gambling. There is no winner takes all approach. You can only have uh, the recovery of what you have lost. Alright, these are the main principles of insurance. These are mandatory for an insurance contract. There are other insurance principles also, but we shall not be discovering them in proper level. However, these principles are major. In the indemnity principle, you will always look at the replacement cost, that how much will it cost to restore or replace the damaged good with the new good. As long as that can be proved, you don't have to look at the insurance cover first. Okay. Let us now discuss the Employee State Insurance Act 1948. The promulgation of the Employee State Insurance Act or the ESI Act was the first major legislation on social security for workers in independent India. The act encompasses certain health related eventualities that workers are generally exposed to, such as sickness, maternity, temporary or permanent disablement, etc. So this was the first ever social security legislation that was enacted in India after independence. Okay. There are 6 types of benefits that are provided under the Employee State Insurance Act. First is the medical benefits, then we have maternity benefits, sickness benefits, disablement benefits, dependent benefits and other benefits. Basically, confinement expenses, funeral expenses, etc. Okay. So let us discuss these different benefits that are provided under the ESI Act. First are medical benefits. The full medical care is provided to an insured person. Insured person is a constant term within the ESI Act, that only those employees which are insured shall be taken care of under this. Alright, is provided to an insured person and his family members from the day he enters the insurable employment. The employment has to be insurable in this case. There is no ceiling on expenditure on the treatment of an insured person or his family as long as the ESI contribution has been made. Medical care is also provided to retired and permanently disabled insured persons and their spouses on payment of a token annual premium of 120 rupees. Then we have maternity benefits. The maternity benefits for confinement and pregnancy is payable for 26 weeks. Okay. This is extendable by further 1 month on medical advice at the rate of full wage, subject to contribution for 70 days in the preceding 2 contribution periods. So if the employer and employee both have contributed sufficiently, then upon medical issues arising, a 1 month extension can also be granted to the woman for confinement or pregnancy. Then we come to sickness benefits. Sickness benefit in the form of cash compensation at the rate of 70% of wages is payable to the insured workers during periods of certified sickness. You need to get it certified from a medical practitioner as approved by the employer. Sickness benefits can only be granted for a maximum of 91 days in a year. That at most for 3 months you can be sick, but not more than that. In order to qualify for sickness benefit, the insured worker is required to contribute for 78 days in a contribution period of 6 months. Okay, there are two contribution periods from April to October, and October to April, both of these have to be covered. Then we come to disablement benefit. There are two types of disablements. First is temporary disablement benefit, and next is the permanent disablement benefit. So for temporary disablement, from day one of the entering of the insurable employment, and irrespective of having paid any contribution in case of employment injury, the temporary disablement benefit shall commence. Temporary disablement is at the rate of 90% of wage payable as long as the disability continues. This is because employees can get injured anytime. The purpose of the entire Employee State Insurance Act was to ensure that there is sufficient social net if people are unable to receive wages. If someone is injured or temporarily disabled, then it's not their fault. They cannot earn during that time, and that is why it is necessary to grant them social insurance. The next is permanent disablement benefit. The permanent benefit disablement is paid at the rate of 90% of wage in the form of monthly payment depending upon the extent of loss of earning capacity as certified by the medical board. So if someone loses one finger versus loses one hand, they will be paid according to the extent of the injury through a monthly payment. Okay. Then there are dependent benefits. This is also paid at the rate of 90% of wage in the form of monthly payment to the dependents of a deceased insurance person in case where death occurs due to employment injury or occupational hazards. So every month the children, spouse or dependent parents or anyone else who is considered family shall receive dependent benefits every month regularly for the rest of their lives. But this is only when it is proved that the death occurred due to employment injury or occupational hazards. And this is normally where a lot of litigation happens, that sometimes there is a worker death and the worker might be slightly drunk on the job. So the employer will say that, listen, we are not responsible, that there is no liability because we did not ask them to be drinking alcohol. But the worker might say, listen, you were required to properly fence hazardous machinery. You failed anyway. How is my conduct a problem when you anyway failed and you were liable from that moment itself? So this is where law normally comes into play and a lot of litigation happens. There are some other benefits under the Act. First is the funeral expenses. An amount of rupees 15,000 is payable to the dependents or to the person who performs the last rites from day one of entering insurable interest. Okay. From day one, you will have to pay funeral expenses if the person has died during the employment. The next is confinement expenses. Insured woman or insured person in respect of his wife in case of confinement occurs at a place where necessary medical facilities under ESI scheme are not available. Confinement is when labor is resulting in delivery of a child and there is no medical facility available nearby, then you have to pay the confinement expenses to the employee if the employee is a woman, or to the employee's wife, or for the employee's wife in case the employee is a married man. Okay. There is one statutory authority which has been established under the ESI Act. This is the Employee State Insurance Corporation. This is a statutory body established under the ESI Act 1948. It functions under the Ministry of Labor. Okay. It administers the implementation of the ESI scheme, the Employee State Insurance Scheme. It comprises members representing vital interest groups including employees, employers, central and state government, representatives of parliament and medical profession. Okay. So various activities, because there is always a health risk, so you need medical professionals, you need legislators, policy advisors, as well as representatives of both industrial groups as well as trade unions, workers and employers. The corporation, the ESIC, the Employee State Insurance Corporation, is headed by the Union Minister of Labor as its chairman. Okay, so please understand how big the ESIC is, that the Union Cabinet Minister on Labor is the head of the ESIC, whereas the Director General appointed by the central government functions as its CEO. This is normally an IAS officer who is appointed as the DG of ESIEC. Okay. The applicability of the Act is for non-seasonal factories only. For seasonal employment, there is no ESIC Act. employing 10 or more persons. This threshold has been increased to 20 employees in Maharashtra and Chandigarh. Schemes, the ESI scheme has been extended to shops, hotels, restaurants, cinema, including preview theatres, road motor transport undertakings, newspaper establishments, employing 10 or more persons. The scheme has also been extended to private medical and educational institutions. The existing wage limit for coverage under the Act is rupees 21,000 per month from 2017 onwards. Okay, that the scheme which is administered by the ESIC is extended to educational institutions, medical colleges, as well as for journalists, road motor transports, and the hospitality industries, cinema halls, etc. Now let us discuss the contributions. The ESI scheme, like most of the social security schemes the world over, is a self-financing health insurance scheme that it raises its own funds. Contributions are raised from covered employees and their employers as a fixed percentage of wages. Employees' contribution is 0.75% of the wages and the employer's contribution is 3.25% of the wages. Okay, a total of 4%, where almost 80% fund is borne by the employer and 20% is borne by the employee. Okay. Employees in receipt of daily wage up to rupees 176 are exempted from payment of contribution. Why? Because they are anyway earning less. The employers, however, will contribute their own share in respect of these employees. So, it is only the employee who is exempt. The employer will continue. Employer shall pay his contribution and deduct the employee's contribution from wages within 15 days of the last calendar month. It is the responsibility of the employer to ensure that the payment of the insurance premium happens in a timely manner. Let us also briefly discuss the PM Jeevan Jyoti Bima Yojana. The PM Jeevan Jyoti Bima Yojana now has been one of the major life insurance schemes financed by the government. Any Indian citizen that falls in the age category of 18 to 50 years with an active savings account can avail of this policy. It was launched in the year 2015. PM Jeevan Jyoti Bima Yojana offers a life coverage of rupees 2 lakh at a nominal premium of rupees 330 per annum. Okay, so you pay only rupees 330 every year, but in case of death, the dependents or the nominees of the life insurance policy will receive the massive sum of rupees 2 lakhs. This is an auto renewable insurance plan and premiums will be auto debited from associated banks annually. So every year, once you opt for it, there is an opt-out model, but otherwise you will continue to pay rupees 330 per annum for the purpose of life insurance. So this ensures cheap life insurance every year. Let's discuss the inclusions and exclusions of the PMJJBY, the Jeevan Jyoti Bima Yojana. The JJBY plan covers all life risks, all the life risks. All death benefits will be paid after 45 days of death after verification. The coverage period begins from June 1 every year to May 31 of the next year. The natural or accidental death of the policyholder allows the family members to claim compensation under the JJBY. However, it is mandatory to submit a death certificate for documentation purposes. Okay. So, the family members can claim the monetary amount within 45 days, but they have to submit a death certificate so that there is official record of death. This will also ensure people don't get wrongful death certificates, etc., and that there is an incentive for people to notify deaths. Now let's also discuss the specific exclusions. First, if a person is above 55 years, then the death cover offered will be terminated. That you can only buy the policy from the age of 18 to 50 years, and after 55 years you are no longer eligible even for the returns. If the member is covered through more than one bank account, you can't receive the death benefits. You can only take the benefits once. If the policy holder has insufficient balance in their savings account, the policy will be terminated. You need to constantly ensure that at least rupees 330 exist in the account so that you can claim the benefits. This is also not available if the person has died by suicide. Okay. If the cause of death is suicide, then it will not be compensated. It can only be in cases of accidental death normally or by disease. Now let us discuss the PM Suraksha Bima Yojana, the PM SBY. This is an accident insurance policy. The Jeevan Jyoti Bima Yojana was a life insurance policy. This is an accident insurance policy. One can purchase the policy for a nominal amount of rupees 12. Okay. Basically 12 रुपये में अगर आपको, if in 12 rupees you are getting a entire life insurance, accident insurance. The policy's beneficiaries will receive the death benefit after insured's unfortunate demise in an accident. There is also a health insurance premium which is debited from the linked savings bank account. Applicants can choose between a long-term policy or an annually renewable plan as per convenience. This is giving flexibility to the policy holder. The exit and re-entry measures are simple to understand. It also offers tax benefits. So basically this is to increase the insurance penetration and insurance density of India. At present it is very low, and so Suraksha Bima Yojana is one way to see that although it is heavily financed, subsidized by the government, but that is still much better than people not having insurance at all. Okay. So let's discuss first the benefits of the Suraksha Bima Yojana. First, this health insurance policy offers accident insurance coverage without spending a lot of money. You're only spending rupees 12 every year. The policy provides financial aid to the dependents if the insured person dies. So in case of death, there is a guarantee that the dependents will at least receive some money. Then with the auto debit option, the insurer no longer has to worry about missing premium dates. That अब हर साल आपसे 12 रुपये, if anyone deducts 12 rupees, you might not care for very long. But in case a mishappening occurs, you don't want to be the person who does not have accident insurance. So therefore, the auto debit option is a very good option so that people don't miss the deadlines for premium payment. The policy offers secure processing and continuous coverage. The insured gets flexibility to either continue or discontinue the plan as per their wish. There is also an annual plan if someone wants, or there is a continuous plan if someone wants, and you can constantly change that also. The premiums paid towards the policy can be claimed for tax deductions under 80C of the old income tax regime. Please remember there are now two regimes, the new regime and old regime. Also, a sum of up to rupees 1 lakh received by the beneficiaries is non-taxable under the Income Tax Act. So, up to 1 lakh rupees, you will not be having to pay any tax even as insurance benefits. Okay. The eligibility criteria for the Suraksha Bima Yojana is 18 to 70 years. For Jeevan Jyoti Bima Yojana, it was 18 to 50 years. For Suraksha Bima Yojana, it's 18 to 70 years with a savings account. The Aadhaar card must be furnished as a primary KYC document. The applicant can join the scheme only through a single bank account. In case of a joint account, all account holders can join the scheme. If the applicant is a non-resident Indian or an NRI, although eligible, the benefit will be paid in insured nominee rupees. Okay, so let's say you are living in the US and an injury occurs, you will be required to pay in US dollar, but you will only be paid in rupees. The rest is your own issue. However, NRIs can also contribute. It is not limited to citizens only. This is very helpful, especially for the workers in the Gulf region who at times might fall sick and are anyway not being paid very high wages. They also get to benefit. Let's look at the coverage of the Suraksha Bima Yojana. That first, it covers an accident leading to the insured's death. In this case, you will get rupees 2 lakhs to the beneficiaries or dependents of the policy. In case of permanent total disability, again you will get rupees 2 lakh yourself, not your dependents. And in case of permanent partial disability, rupees 1 lakh. What is permanent partial disability? Let's say one finger got chopped off. That is a partial disability. That is not a total disability. You can enable the auto debit facility. Once this amount is debited, the policy will automatically renew. So even if you have cancelled the payment once, you can renew it automatically. The PM Suraksha Bima Yojana can be renewed annually and has a duration from June 1 to May 31st. There are some limitations also. Even this case does not cover death or self-inflicted accident for attempt to suicide. non-permanent disabilities are not covered. So let's say you injure your knee, that will not be covered because these are only permanent, either partial permanent or total permanent, but nothing except for permanent injury is covered. Permanent injury or death, these are the only cases which are covered under the Suraksha Bima Yojana. Okay. There is a loss of cover under the Suraksha Bima Yojana once a person attains 70 years of age. Also, if the savings account does not even have the minimum balance of rupees 12 per annum to pay, then also you will lose the loss of cover. If you have multiple accounts, the insurance premium account will be debited from one account, and if you have auto debited from multiple accounts, then the extra premium will not be refunded. However, because this is rupees 12 only, many people might not care. It's still better to mind where your money is going. If the insurance cover is terminated due to technical reasons or insufficient balance, it can be reinstated after premium is paid in full. This is to ensure that people don't lose out on the benefits of this social security scheme. It is not a profit scheme, it's a social security scheme. So, this is how the PM Suraksha Bima Yojana works. There is also the Ayushman Bharat PM Jan Arogya Yojana, which is the world's largest health insurance or assurance scheme fully financed by the government. The PMJ provides for a insurance cover of rupees 5 lakhs per family for secondary and tertiary care hospitalization across private and public empaneled hospitals. Okay. So, basically, there are multiple levels: primary healthcare, secondary healthcare, and tertiary healthcare. The primary healthcare is normally health and wellness center, which also the Ayushman Bharat program is creating in every district and rural areas as well as urban areas. And the secondary and the tertiary, they are giving to both private and public, because at times public hospitals are too crowded and people have to be referred to private hospitals. So, up till rupees 5 lakhs per year, the entirety of the private sector is also involved. This increases the scope of where people can go to avail services, so that they are not restricted just because public hospitals are too caught up. Over 10 crore poor and vulnerable entitled families, approximately 50 crore beneficiaries basically, have been eligible for these benefits. The bottom 40% under the social economic caste census are eligible as per the Ayushman Bharat scheme. So, they are measured on a deprivation as well as occupational criteria in the SECC 2011 socio-economic caste census for both rural areas as well as urban areas. The PMJ provides for cashless access to healthcare services for beneficiary at the point of service, that is hospital. So, the hospital which has been empaneled shall be paid by the government directly. The PMJ envisions to help mitigate catastrophic expenditure on medical treatment, which pushes 6 crore Indians into poverty each year. The out-of-pocket expenditure was 68% earlier in India, After the PMJ, it has come down to 48%. So a lot of savings have happened for the poor families in India. Okay. The coverage of the Jan Arogya Yojana is as follows. It covers up to 3 days of pre-hospitalization and 15 days of post-hospitalization expenses such as diagnostics and medicines. So basically, even if you have to get your blood test for important vitamin deficiencies, etc., before a surgery, because you need to know whether you can go through a surgery or not, that will be covered. Pre-hospitalization expenditure will be covered. There is no restriction on family size, age or gender. You might have a family of 10 people, but up till the limit of rupees 5 lakhs, there is no limit on what the size of the family is. This is on a floating basis. That let's say one member gets hospitalized and is fined rupees 50,000, another member spends rupees 1 lakh, another spends rupees 2 lakh. All of this is fine. Up till rupees 5 lakhs, multiple members can face hospitalization and the government will cover for it. All pre-existing conditions are covered from day one. The benefits of the scheme are portable across country. A beneficiary can visit any impaneled public or private hospital to avail cashless benefit. The services include approximately 1393 procedures covering all the costs related to treatment, not excluding drugs, supplies, diagnostics, physician fees, room charges, surgeon charges, OT, ICU charges, etc. So all operation theatre, intensive critical unit, all of these will also be covered, and up till rupees 5 lakhs you don't have to pay anything. Okay, so that poor people don't end up losing and getting deeper into poverty. This saves the lives very effectively. The public hospitals are reimbursed for healthcare services at par with the private hospitals. It's not that public hospitals have to provide services at a subsidized rate. They will also be paid the way they are supposed to be paid. This is a very major scheme for health insurance. Let us discuss some previous year questions. First, which one of the following is the amount of annual premium for Pradhan Mantri Suraksha Bima Yojana for accident and disability cover up to rupees 2 lakhs? A. Rupees 100, B. Rupees 50, C. Rupees 20 or D. Rupees 12. We discussed the PMSBY in depth, that only for rupees 12 you will get accident and disability cover up to rupees 2 lakhs. Remember, this is only for permanent disability, not for temporary accidents. Okay, but only in rupees 12. So the answer is D, rupees 12. Let us discuss the next one. Which one of the following is a statutory machinery functioning at the central level? A. Central Implementation and Evaluation Committee. B. Central Board for Workers' Education. C. Standing Labour Committee. Or D. Employee State Insurance Corporation. We just discussed in this class that the Employee State Insurance Corporation is a statutory machinery under the Central ESI Act. 1948. So therefore, its chairperson is the Union Minister for Labor. Okay. So the answer here is D, Employee State Insurance Corporation. Let us discuss one last PYQ. For the first time in India, medical benefit as a non-cash benefit was provided under A, the Employee State Insurance Act, B, the Factories Act, C, the Maternity Benefit Act, and D, the Mines Act. We discussed this also in this class. The answer is A. Employee State Insurance Act was the first time that any social security legislation was enacted in India, and medical benefits including disablement benefits, sickness benefits, all of these were provided to employees. So the answer is A, the Employee State Insurance Act 1948. Okay, thank you. Hello everyone. Welcome to the third and final class for Social Security for EPFO. In this class, we shall discuss pension and financial security schemes, especially the Provident Fund. Okay, let us begin. So let's come to the provisions of the Employees Provident Fund and Miscellaneous Provisions Act. Okay, this is the organization under which the EPFO, the exam for which you are appearing, is established. So at the end of the final journey, we have ultimately reached to the point where we are learning about the EPFO also. Okay, so this act is called the EPF and MP Act. Okay, the Employees Provident Fund and Miscellaneous Provisions Act of 1952. Okay, this act has been enacted to provide social security after retirement in the form of provident fund, pension, etc. Okay, what is a provident fund? Provident fund is a deposit based investment fund which provides lump sum payment. Lump sum payment being the keyword. Okay, in a pension scheme there is a regular payment, not a lump sum payment. So this is the primary difference that you will find between provident fund and a pension fund. Under this act, three schemes have been formulated primarily. First is the EPF scheme or the Employee Provident Fund scheme of 1952. Second is the Employees Pension scheme of 1995, and the last is Employees Deposit Linked Insurance scheme or the EDLI scheme of 1976. So these are the three schemes under the EPF MP Act. Okay, we shall be discussing all of them. Prior to this, let us look at the applicability of the EPF Act. This act applies to every factory engaged in any industry specified in Schedule 1 of this act in which 20 or more persons are employed. Okay. Secondly, in every other establishment employing 20 or more persons which the central government may notify. Okay. So either the central government or the Schedule 1. These are the only two conditions in which the EPFMP Act applies. This is a central act. Okay. The state government has very less power in under the EPF Act. Please note that once this act applies, it continues to apply even if the number of employees falls below 20. Okay. So if your employees have now been registered for EPF, then cannot deregister them later because it is a welfare statute. So for the welfare of the workers, you have to take these steps. All right. The act does not apply to, firstly, a cooperative society employing less than 50 persons and working without the aid of power. Secondly, a new setup establishment for an initial period of 5 years. Okay, this is to give breathing space to new industries because you are hiring new employees. You're hiring new employees. You're getting all registrations done, etc. So, to give breathing space to new establishments, the Act does not apply for the initial period of 5 years. And thirdly, any central or state government establishment having its own scheme of provident fund. Okay, please remember the concept of provident fund we had discussed was in the concurrent list. So, therefore, central and state government can have separate schemes of provident fund as well for their employees. So this is the applicability as well as the exceptions to the applicability of the EPFMP Act. Who is eligible for the EPF scheme? The Employees Provident Fund scheme. An employee whose salary, which is basic plus DA, dearness allowance included, is less than 15,000 per month can join. Okay. Those who are earning more than 15,000 per month are not eligible, but still they can become members of the EPF scheme with the permission of the Assistant Provident Fund Commissioner, the APFC. Okay, this is also a position which is open through examination in this season. However, in such a case, the Provident Fund contribution will be as per rupees 15,000 per month only. It will not be as per 1 lakh rupees. If an employee is earning 1 lakh rupees, does not mean they will get PF contribution at the same rate. An employee ceases to be a member of the EPF scheme on attaining the age of 60 years because after this the lump sum will be paid. Okay. Let us discuss the contribution to the EPF scheme by both employer and the employee. Both of them contribute. So the employer contributes 3.67% of the worker's salary, basic plus DA, in the PF account. 3.67%. Okay. The total contribution, please remember, we will discuss in the next slide only, is 12%, of which 8.33% is in the employee pension scheme and 3.67% in the EPF scheme. The employee contributes 12% of salary in the PF account. The employee can voluntarily pay more contribution above the statutory rate also. However, the employer does not have to match the voluntary contribution over and above the statutory rate. So the employee can pay 15%, 17% also, but that is not binding on the employer. The employer has the statutory upper limit of 12% total set. Okay. The other scheme, which is the employee pension scheme, is one where only the employer will have to contribute, not the worker. Okay. The employer will contribute 8.33% of the salary into the pension account. So this makes the employer's contribution as 12% and the employee's contribution also 12%. Okay. Remember the breakup. 3.67% is for EPF and 8.33% is for employee pension scheme, the EPS. Okay, whereas the employee's contribution is completely for EPF. Now let us discuss the provisions of the employee pension scheme. We had discussed the employee provident fund scheme, the EPF scheme. Now we'll discuss the employee pension scheme. Okay. The members of this pension scheme will get pension on three conditions. Firstly, superannuation, which is when you complete the maximum age for a job. For example, in government service, it is 60 years, after which you superannuate. The second is from retirement from service, such as the voluntary retirement scheme. Even if you take that, sometimes you are eligible for pension scheme. Okay. And the third one is disablement during service. So if something happens to you while you're presently serving in the capacity as an employee, if something happens to you that causes disablement, then also you will be entitled to pension from that age. So these are the three circumstances in which the pension scheme will kick in, will commence either upon superannuation or upon retirement or upon disablement. Okay. The family pension will be available to the widow or the widower. Widow is wife of dead husband and widower is husband of a dead wife. Okay. For life, for their entire life, or until they remarry again. In addition, the children will also be entitled to pension up to 25 years of their age. This is to ensure that dependents are not left to survive on their own. This ensures that they have something to look forward to. to give them financial security. If the person is unmarried or has no family, pension will be given to nominee for the specified period. Okay. When you sign up for the pension scheme, you have to indicate a nominee. So this nominee will get the benefits for specified period as it is notified by the government. Okay. The formula for pension is as follows, because you have to calculate the member's monthly pension. It is pensionable salary into pensionable service plus 2, pensionable years in service plus 2 upon 70. So pensionable salary is average of last 60 months of pay. Last 5 years whatever you earned, the average monthly pay is the pensionable salary that you multiply into number of years of service plus 2 and then divide the whole by 70, so that you get pensionable salary. This is just a formula. I hope this is not asked in the EPFO exam, but I'm just giving you the basic knowledge. Now let's come to the Employees Deposit Linked Insurance Scheme 1976. We'll just cover this briefly. Only the employer has to contribute in this. Employee does not contribute any amount. Does not contribute any amount. The employer pays 0.5% of the salary of the worker. This, once again, this is basic plus dearness allowance. The administrative charges of 0.1% of salary are also paid by the employer. This is basically an insurance scheme, a life insurance scheme. If an employee dies during the employment, his nominee or family will get an amount equal to the average balance in PF account of the deceased employee during the last 12 months. And if this average balance is more than rupees 50,000, then the insurance amount payable is 50,000 plus 40% of the amount in excess of rupees 50,000. Okay, so if every year the average balance in the last 12 months was 50,000, then you will get up to 50,000. Otherwise, you will get up to 70,000 rupees. Okay, just for the sake of immediate life insurance security. Now we come to the Employee Provident Fund Organization, or the EPFO. The EPFO is a statutory organization constituted under the Employee Provident Fund and Miscellaneous Provisions Act 1952. This organization administers this act and three schemes of this act. Basically, the three schemes which we discussed: the EPF scheme, the EPS scheme or the Employee Pension Scheme, and the EDLI scheme or the Employee Deposit Linked Insurance Scheme. All of these three are administered by the EPFO. The EPFO is under a Central Board of Trustees, or the CBT. The CBT is a statutory body constituted by the central government under the EPF-MP Act. Please remember, all bodies under the EPF-MP Act are by the central government only, because this is a central act. The tenure of the board is 5 years. Alright. These were some of the basic organizational details of the EPFO. The Central Board of Trustees is composed of the following uh, setup. First is the chairman, which is the Union Minister for Labor. So, a cabinet rank minister is the chairperson. Then we have the vice chairperson, which will be a nominee of the government of the central government. Then we have a central provident fund commissioner. The vice chairman is normally the minister of state and the labor secretary. There are multiple vice chairpersons. Then we have the central provident fund commissioner, which is basically a person of the additional secretary rank in the EPFO, in the labor ministry. Besides this, we have 5 central government representatives, 15 state government representatives on a rotation basis. Different states send their nominees. 10 representatives of employees and 10 representatives of employers. So, all of these comprise the Central Board of Trustees. These ensure that there is a balanced, negotiated approach for the future of Provident Fund. Okay. The EPFO came up with a concept of the Universal Account Number or the UAN. Okay. The UAN is a unique number generated by the EPFO for its members. Members are any employee who will be beneficiary from the Provident Fund. Alright, this was started in the year 2014. It is a 12-digit number. Regardless of the change in organization and designation, the employee's UAN will remain the same. So let's say I shift from factory A to B, or I shift from worker to supervisor. In both cases, whether it is a change in organization or designation, or whether I am a supervisor in factory B, in all such cases, the UAN will remain the same. It is linked to my identity. Okay. A member can use EPFO's online services with their UAN, including e-nomination and to check the EPF balance. Basically, UAN allows for login ID to the web application of EPFO. Alright. The UAN provides automatic portability of Provident Fund account on change of employment if the employee has activated his UAN by seeding his KYC, know your customer details, through the employer. Okay. The employer has to provide for the KYC documentation to the employee, after which the employee will receive the UAN. So once the employer has seeded, this is important because ultimately it certifies that someone is employed by the employer only. Otherwise, if I myself register the UAN under some employer who has not even employed me, and later on I say that, listen, I was your employee, so please pay me salary, and they have no record of me, so that will lead to a lot of court matters. So the employer has to certify that you are their employee. Only after that will you get the UAN registration. Okay. So this was the setup of the Employee Provident Fund Organization, the EPFO, as well as the various schemes of the EPF-MP Act. We discussed three schemes: the EPF scheme, the Employee Provident Fund scheme, the EPS scheme, the Employee Pension scheme, and the EDLI scheme, or the Employee Deposit Linked Insurance scheme. Okay. Now let us move on to the eShram portal. So the eShram portal was launched by the Ministry of Labour and Employment during the COVID-19 pandemic lockdown. Okay. The purpose was creating a national database of unorganized workers which will be seeded with Aadhaar access. Okay. This portal matches employees or potential employees with the employers. Okay, so this is for matching the demand and supply of employment. It was very important to have this sort of database because in the absence of it, there is no registry of unorganized workers. The migrant crisis which happened was because there was no registry. Secondly, it is difficult to have skill mapping. If you don't know what is the skill set of your population, how will you attract industries? Because the industrialist has to know what is the skill that they can avail when they enter any state or any region. Therefore, the eShram portal has details of the name, the occupation of the person, the address of the person, the occupation type, as in primary sector, skilled, unskilled, etc. The educational qualifications, degree, 10th pass, 8th pass, etc., 12th pass, and the skill type, whether they are mechanical, whether they are construction or plumbing, etc. All of these are different skills. So it depends on which skill type also will be mapped. This will allow optimum realization of the employability of the portal workers, and this can extend the benefits of social security schemes to the workers registered on the eShram portal. Okay, so this has dual use. First is skill mapping, and second is worker mapping, that you know where the worker is so that you can provide them with services, social security services. It is a massive success for the central government because as of March, 28.5 crore workers, unorganized workers, had been registered on the eShram portal. So this is a massive number and a massive win for the government. These are the objectives of the eShram portal. The first main objective is to create a centralized database of every construction worker, migrant worker, gig and platform worker, street vendor, domestic worker, agricultural worker, etc., which will help them to implement the social security services to them and to share their information with various stakeholders for delivering the welfare schemes. Okay. The next big objective is the portability of social security and welfare benefits to the migrant and construction workers, and providing a comprehensive database to central and state governments for tackling any national crisis. By tracking workers, you can prevent the migrant exodus that happened during the COVID-19 era. Yes, so this allows for portability of the social security schemes. This also means that we are finally moving to the citizen concept of labor, that they are allowed uh, labor welfare for the reason that they are human resources, they are human beings. Okay. Now we come to some of the pension schemes for the government. We will be discussing the PM Shram Yogi Mandhan Yojana, the Atal Pension Yojana, the PM Vaya Vandana Yojana, and the Sukanya Samriddhi Yojana. We will be discussing all of these. I will also be giving you a brief of the Kisan Mandhan Yojana. Although you will see that the provisions are completely the same with PM Shram Yogi Mandhan Yojana, which is why I am not covering it separately. I am only going to give a brief of it in the same slides. Alright. So the PM Shram Yogi Mandhan Yojana is basically the scheme for unorganized labor. Shram Yogi, Shram means labor, so Shram Yogi is someone who uses their labor. Mandhan means pension. It means, if you translate it, it means man, which means honor or pride, and dhan, which means money. So that people who have lived their life as laborers can also be live a life of dignity and pride once they retire, that they have worked and contributed to the nation's economic growth, and they are getting a reward for that ultimately as a pension. So this is the purpose of the PM Shram Yogi Mandhan Yojana. The eligibility criteria for the scheme is as follows. Firstly, the person should be an unorganized sector worker. They should not be a regular employee of any place. Secondly, the entry age is between 18 and 40 years. Alright. And lastly, the monthly income should be rupees 15,000 or below. So this is only applicable to workers. We saw that the new definition everywhere has been shifted to rupees 15,000 per month. The worker should not be in any case engaged in the organized sector, such as membership of the EPF, the National Pension Scheme, or the Employee State Insurance Corporation. If any of these exist, then that means the worker belongs to the organized sector. Okay, so that is an ineligibility. The second is the worker should not be an income taxpayer. If they are earning more than rupees 5 lakh rupees per annum, then they are not considered. So you should be sufficiently covered through need of extra income security for you to be eligible for the PM Shram Yogi Mandhan Yojana. Alright, therefore you cannot be a worker of the organized sector, and you cannot be an income taxpayer. Lastly, last condition is that he or she should possess an Aadhaar card as well as a savings bank account or a Jan Dhan account with the IFSC code number. Okay. The Aadhaar card provides for their identity, and the Jan Dhan card provides for their bank info to which the amount is transferred later on. So these are the basic eligibility criteria for the Shram Yogi Mandhan Yojana. These are the features. Firstly, it is a voluntary and contributory pension scheme. The subscriber would receive a minimum assured pension of rupees 3000 per month after attaining the age of 60 years. If the subscriber dies, the spouse of the beneficiary shall be entitled to receive 50% of the pension as family pension. Family pension here is applicable only to the spouse. It is not applicable to the children. This was allowed in the case of the EPFO, but not in the case of Shram Yogi Mandhan. Okay. The applicants between the age group of 18 to 40 years will have to make monthly contributions, okay, ranging from rupees 55 to 200 rupees per month till they attain the age of 60. The central government will also give equal matching contribution in his pension account. So if you give rupees 55 per month, the central government will also give 55 per month. If you give 100 per month, then the central government will also pay more. So you have incentive to pay more. Okay. This is administered by the Ministry of Labor and implemented by the LIC, the Life Insurance Corporation of India. Alright. So while the Ministry of Labor is responsible for data, the LIC is responsible for the fund disbursement and investments. These funds are collected and invested someplace for them to be repaid at a later date. So this fund investment shall be implemented by the Life Insurance Corporation. Now we come to the Atal Pension Yojana. The Atal Pension Yojana is a pension scheme for citizens of India with a focus on workers in the unorganized sector. This was started in 2015, and the PFRDA, or the Pension Fund Regulatory Development Authority. The PFRDA is the fund manager. In all pension funds, you have a similar system where there is a pension fund where you contribute and they pool the funds, pool contributions to invest them in the market. This grows as the value of investment grows, and from this increased value, they pay beneficiaries. All right, this is how any pension fund works. So in this case, the PFRDA is a fund manager. These are the features of the Atal Pension Yojana. Firstly, there is a guaranteed minimum pension of rupees in 5 slabs, 1000, 2000, 3000, 4000 or 5000 per month at the age of 60 years will be given on the basis of contribution by the subscribers. Okay, so 5 slabs will be paid. Next, the persons between the age of 18 and 40 years can join, same as the Shram Yogi Mandhan Yojana, because you will need at least 20 years of gestation for the pension fund to have enough that they can cover your entire life, right? That every month you have to pay some amount, so at least pay for 20 years so that you can receive a much bigger amount in the coming 15-20 years. The liability of the PFRDA or whichever pension fund is uncertain. They don't know how many years you will live. Another feature is that the person should have their own savings bank account. This encourages financial inclusion. It was a scheme of 2015, so every such scheme had a savings bank account system because that was one of the major priorities of the government then. And the government will co-contribute 50% of the total contribution or 1000 per year, whichever is less, to each eligible subscriber who joins the scheme between 1st June 2015 to 31st March 2016 and not a member of any other social security scheme. This was one of the ways to incentivize joining of the Atal Pension Yojana. Now we come to the next scheme, which is the PM Vaya Vandana Yojana. This is a scheme, social security scheme for the elderly population. Vaya means elderly, Vandana means paying respect or to bow in front of someone. So elderly have to be paid respect, and this is why the scheme has been called the PM Vaya Vandana Yojana. The main aim of the scheme is to provide senior citizens with a regular pension during a time when there is a fall in interest rates. This was recently launched in 2019 to 20 when interest rates were drastically falling. So, savings rate of interest would have decreased significantly, and so the returns to elderly people, especially those who focus on FDs, fixed deposits, etc., would have been much less. So that is why the PM Vaya Vandana Yojana was launched. Okay, in this case also LIC is the management authority. Okay, the same way for PM Shram Yogi Mandhan Yojana, Uh, for Vaya Vandana Yojana also, the LIC is responsible. Please also remember that even for Kisan Mandhan Yojana, the provisions are the same that as the Shram Yogi Mandhan Yojana. So, Kisan Mandhan, Shram Yogi Mandhan, and the Vyapari Mandhan. All of these provide for 18 to 40 years joining age, 55 to 200 rupees per month contribution, and rupees 3000 per month pension. Alright, only the Atal Pension Yojana provided for 5 slabs of rupees 1000, 2000, 3000, 4000, 5000, etc. Okay. So these are the list of benefits under the PM Vaya Vandana Yojana scheme. Firstly, the minimum age of entry must be 60 years or above, because this is for the elderly only. The maximum age of entry, there is no limit. You can be as old as you are at present, above the age of 60, and you can enter the scheme for your own protection. The duration of the policy is 10 years. So if you take it at the age of 75, you will complete the policy at the age of 85. The minimum pension that is earned for quarter, monthly, half yearly, and yearly are 1000, 3000, 6000, and 10,000 respectively. You can opt for whichever way you want. The maximum pension that can be earned is rupees 10,000 per month. Under this scheme, the pensioner will receive an assured return of 8% per annum for the policy duration of 10 years. Okay. Therefore, you can invest amount no matter what the interest rate is going, you will still get an assured return of at least 8%. There is also a loan facility that after completing 3 years of the policy, a maximum of 75% of the purchase price can be availed as a loan. So therefore, you can re-borrow whatever you have invested. There is a maturity benefit. If the pensioner survives the entire policy tenure, the purchase price will be paid along with the final pension installment. Okay, so it is not just pension but also the purchase price. The aim of the policy is not that the government makes profit. The aim of the policy is that the people should have social security, and that should be financed partly through their own contribution. Last is the death benefit, that the purchase price will be paid back to the beneficiary if the pensioner passes away during the policy tenure. So therefore, you have to choose the beneficiary who will benefit from your ultimate demise, and they will be paid the entire sum once the pensioner has deceased. Okay, these are some of the provisions of the PM Vaya Vandana Yojana. We come to the last scheme, the Sukanya Samriddhi scheme. All right. The Sukanya Samriddhi scheme was a part of the Beti Bachao Beti Padhao campaign. This was launched on 22nd January 2015. This is the Beti Bachao Day by the Prime Minister in Panipat, Haryana. Okay. The scheme is aimed at betterment of the girl child in a country by abolishing sex determination, gender discrimination, protection of girls, and higher participation of girls should be ensured in education and other fields. The Sukanya Samriddhi Yojana aims at tackling a major problem associated with the girl child, which is education and marriage expenses. So, it is focused on securing a bright future for the girl child in India by facilitating the parents of a girl child in building a fund for the proper education and carefree marriage expenses of their child. Once parents are assured that these expenses will be taken care of, they will be able to support the girl child better. Okay, so that is why the Sukanya Samriddhi Yojana was launched. These are the features of the Sukanya Samriddhi Yojana. Firstly, only one Sukanya Samriddhi Yojana account, SSY account, for a girl child can be opened. Second, the SSY account can be opened in any post office or branch of commercial bank. Third, it can be opened any time between the birth of the girl till the time she attains age of 10, so that by the time she is an adult she has enough uh, amount in her deposit. Fourth, the guardian can deposit the amount and operate the account till the girl attains the age of 18 years. Fifth, the SSY account shall be mandatorily operated by the girl child after she attains the age of 18 years. Sixth, the minimum deposit amount for an SSY account is rupees 250 per year. This has been reduced recently. It was brought down to 250. Previously, it used to be rupees 1000. Thereafter, in multiples of rupees 50. So you can have 250, 300, 400, 450, 800, 850, etc. Basically, you cannot have rupees 270. The maximum amount per financial year is rupees 1.5 lakhs up to 15 years. Okay. The maturity period is 21 years from opening account or upon her marriage after attaining 18 years. So either the girl turns 21 or marries after 18 age, and after 18 she will manage the account. All right. The contributions, however, only have to be made for 15 years maximum. So therefore, if you start at the age of 1, then by the age of 16 years of the girl, you can stop contributing and you will get the amount. Thereafter, the SSY account will continue to earn interest until maturity, even when no deposits are made into it, so that there is greater financial autonomy for the woman. The benefits of Sukanya Samriddhi scheme are as follows. Firstly, the investments made in the Sukanya Samriddhi Yojana scheme are eligible for deductions under Section 80C of Income Tax Act, subject to maximum cap of rupees 1.5 lakhs. Secondly, the educational expenses are covered. You can withdraw 50% of the account balance as of the previous financial year to meet the educational expenses of your girl child. This can be availed by submitting proof of admission. So therefore, you get financial benefits if you are promoting education. Promoting education of girl child. And there is also convenient transfer from any post office to a bank or vice versa. Post offices have a very wide network within India, especially rural India, and bank network is also rapidly expanding. So this is very easily transferable from one bank branch or post office branch to another, so that if people shift, if they become migrants, then also these account monies can be availed. So these are some of the benefits of the Sukanya Samriddhi Yojana. Now let us look at the previous year questions. First, which one of the following statements is not correct for Atal Pension Yojana? A. There is guaranteed minimum monthly pension for subscribers ranging from rupees 1000 to rupees 5000 per month. This is a correct statement because there are 5 slabs in Atal Pension Yojana for rupees 1000, 2000, 3000, 4000, 5000. We have to look for the not correct statement. Second statement, the benefit of minimum pension would be guaranteed by the Government of India. This is also correct. There is a guaranteed minimum pension every month of rupees 1000. Third, the Government of India co-contributes 50% of the subscribers' contribution of rupees 1000 per annum, or the subscribers' contribution or rupees 1000 per annum, whichever is lower. This is also correct. We discussed this was the scheme which was applicable up till for the incentivization of the Atal Pension Yojana. And last, it is applicable to all citizens of India aged above 40 years. This is incorrect. It is applicable to citizens within the 18 to 40 years gap who are not covered by other schemes. Okay. So the answer here is D. Next question. What is the minimum and maximum age at which a subscriber can join the Atal Pension Yojana? A. 21 years and 58 years respectively. B. 18 years and 40 years respectively. C. 18 years and 50 years respectively. And D. 21 years and 60 years respectively. We have discussed this. The answer is B. 18 years and 40 years respectively. Next question. Under the Sukanya Samriddhi Yojana, what is the maximum amount that can be deposited during a financial year? A. Rupees 1.5 lakh. B. Rupees 1 lakh. C. rupees 2 lakh, or D, rupees 2.5 lakh? The answer we discussed is subject to a maximum cap of rupees 1.5 lakhs. So the answer is A, 1.5 lakhs. So thank you.